Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, June 27th, 2016. Starting this video in pre-market, it's about it's a little before 9 o'clock a.m. Eastern Time. So the charts in this video will be reflective as of Friday's close. I wanted to take a look at XLP, the Consumer Staples ETF, as well as some of the top picks that I have in that sector as short trade ideas. XLP, which I touched on in last night's video, as I went through the charts this weekend, stood out to me as one of the more compelling sectors on the short side right now. And as I often do, I take a top-down approach to trading, or at least my security selection, formulate the broad market overview, the bigger picture, which right now is bearish. And then I drill down and take a look at the overall sectors. And again, most of you know I like to trade long and short. So at just about any given time, I have a mix of long and short trade ideas. Even if the market is going down, assuming my analysis is correct, there'll certainly be sectors or certain commodities that go up, and that's just how the markets work. And so by trading long and short, it's a way of being diversified. And I'll go wherever the charts tell me to go. So this is XLP. This is the, as I mentioned, Consumer Staples ETF. I think a bearish case can be made. It's ironic that, or somewhat odd that my expectation is for a move lower in the markets in the coming months, in the broad markets, yet this is a defensive sector which usually sees a flight to safety bid. Money moves into defensive stocks when the economy slows down. However, the thing about that is the stock market looks out typically 6 to 9 months in advance. And if we go back in time, let's take a look at a longer term chart here. We're on a weekly chart now. Let me go back, zoom out to an 8-day period. And this will encompass the two previous market cycles. We had a bear market that terminated, here's at least in the XLP, in 2003 XLP bottomed. And you can see from this point to the highs in 2008, it went up about 65% or so right there, 70%. Now, this move up has been much greater, about 180%. And the case that I'm going to make here, fundamental-wise, the technical case I'll go through. That's what the charts are all about. But fundamentally, I think a couple things have happened here. Most importantly, this sector is extremely overvalued. Consumer staples, yes, they tend to hold up well in a recession or an economic downturn, as I talked about last night. But valuation levels have been excessive, and what we often see here too. Let's take a look at this period here. Here was a bull market back in 2003 all the way to 2008. Look when the XLP peaked. Let me move that trend line away. XLP peaked right here in late 2008. Now we're looking at 8-day period chart, so this won't give us an exact day, but it gives us the week ending, or the 8-day period ending at the September 29th. So really almost October there. The stock market peaked back in October 2007, so it took over a year. XLP made a higher high, held up, put in a new high 1 year after the stock market peaked back in 07. And that's exactly what's happened here so far. The stock market peaked back, looking at the broad market, there's different indexes we could look at, but the broad market, the S&P 500 peaked back, what was it, May of 2015? So it's been over a year now. We're in late June, and this jives with what happened last time around. So in other words, we've already seen the flight to safety. The markets, as I said, look out 6 to 9 months ahead. And just as we saw back here, you saw up until the market peak, you could see this run up into the consumer staple stocks. And they even held up after the market started correcting. We had an initial sell-off, but they pushed up to new highs a year after the market had peaked. And that's the case so far. And like a lot of other sectors, with this central bank induced, ramp that we've had in the markets, I think a good part of this was just due to the recovery in the economy. However, the returns, like everything else, have been excessive because of the zero interest rate environment, quantitative easing, all the money flooding into the economy. Companies allowed them to do share buybacks, and the valuations have reached extreme levels in the consumer staple stocks, just like the broad market. So the case fundamentally is These stocks are just way overvalued, too much, too soon, and it's just a beautiful setup in the charts. Let's get back to the weekly chart. So here's XLP. There's the primary uptrend line, very well defined. I had to clip off. There was, panic selling into the lows there. This seems to be the trend line that fits best, catches a lot of the bottoms of these candlesticks here. And as you can see, we broke down. The breakdown occurred back in, looks like August of 2015, and push back up, back test, second back test. And if you take this white line here and the yellow line, that's really what we're looking at right now. A large wedge type pattern, negative divergence in place. You can see the PPO on this weekly chart, the RSI. The case is there, I think, for a significant move, a top, I should call it, in XLP, a lasting top. So 2 ways to trade it, and here's why I'm doing the video. For those of you who are either risk adverse, maybe you have a smaller portfolio size, for whatever reason you prefer ETFs, the benefit of trading an ETF over an individual stock is first and foremost diversity. Looks like, according to TC2000, if this is correct, there's 37 individual components in XLP. You can confirm that with the Spiders website. Go online, Google XLP Spiders, and they'll give you the holdings. But either way, you're diversified when you go with an ETF. That's one benefit, and that helps mitigate losses or gains. It cuts both ways. In other words, if you're swing trading some of these companies and you hold the individual stocks, and one of them happens to blow out earnings, has a great quarter that beats expectations, well, that stock can gap up substantially, and that gap can bypass your stop loss order, in which case you've lost more than you planned to on the trade. Can that happen with XLP? Sure, but it's very unlikely, because when you have an ETF, in this case it has almost 40 companies, the impact of any one company will be muted by the remaining companies in there. So any gaps or any moves, I mean, you can just look at the move down on Friday. The XLP dropped less than 2%, and the broad market was down quite a bit more than that. So these aren't firecrackers. These aren't like trading the gold mining stocks, which brings me to one other point, and that is the beta adjusting. I often talk about beta adjusting your position size. If you're not familiar with the term I'm talking about, it's a made-up term, but just go to the FAQ section, go to the top menu of the site, and under trading related questions, I do explain about that. And I usually use that term with volatile instruments like trading Nugget or even GDX or the shipping stocks. Tech stocks tend to be more volatile than the overall market. And what I do is, on a more volatile position, I will reduce my position size to account for that volatility. If you're trading GDX, intraday swings of 5% are the norm, and that's an ETF. That's not even the individual stocks, which of course you have some of those that might swing 10% or more in a day. And the only way, in my opinion, to successfully swing trade those is take a reduced position size, because when you trade those miners, you're looking at 20, 30, 40% gains on a swing trade. And if you typically allow yourself only let's say a 5% loss on a trade, well, you're going to get stopped out within a day. And so what I tell people is, don't even bother swing trading the miners. If you're going to use a 5% stop loss, you might as well just hand your money over to the market. So what you do is you reduce your position size, maybe allow for a 15% loss, but you take a 1/3 position size, a third of your normal size. So what happens if you're stopped out with a 15% stop loss? Your dollar loss is what it would be on a normal trade. And likewise, your gain will be 3 times higher, so you'll still make the same dollar gain as you would on an average trade. Now, why am I talking about GDX and that? The same thing happens in reverse with low beta stocks. So you can trade XLP and you can up your position size. Let's say you normally take 10,000 on a trade of the SPY. XLP is probably less volatile overall than the SPY, so maybe you could do 12,000, 13,000 on position in XLP, because you have usually reduced volatility. And that will also help, therefore, if these gains are a little bit lower than what I'm normally targeting on trades, You put a little bit more money in there, you're making the same dollar amount. And likewise, if you get stopped out, maybe your percentage stop loss is a little lower, but it's the same net dollar amount. So you can use that beta adjusting position size in reverse with low beta positions. TLT is a good example too. That's the government bond ETF. I'm bearish on bonds right now, and you're not going to be down 10% a day in a bond fund, so you can certainly take a larger position and to account for that lower volatility. So enough on that. That is my thoughts on trading these lower beta sectors and also trading ETFs. Now, the benefit of trading individual stocks, which is what I will usually do, is that if I can identify a sector as bullish or bearish, in this case bearish, I can drill down within that sector and normally find the charts of individual stocks that look the most bearish. Let's say ultimately I put on half a dozen trades here in XLP as official trade ideas on the site, or I take those personally. I can't assure you, but I can all but assure you, tell you with a high degree of confidence that I can outperform XLP by sniffing out the 6 most bearish stocks within that sector, especially if I'm right on the move. Even if I'm not right on the move, even if XLP moves higher and I'm looking at the 6 most bearish charts or stocks within XLP, chances are I'll outperform XLP. Maybe that means my losses are less than the trade. If I had shorted XLP and it goes higher, that's what outperformance is. So we'll go through those today. I won't all the stocks that I'll cover. I'm going to cover, let's see, I might have, looks here, I have about over a dozen on my list. Certainly will list a good deal of those, and I wanted to make mention of that because in diversifying your portfolio, if you're going to go the individual stock route, you need to be aware that these stocks are all in the same sector, and I'll put some out today, and I may follow up within the next week or two with additional stocks. So the way I do this, if my entire portfolio, if I carve out, let's just say hypothetically, I haven't finalized anything yet, but let's say I want to take a 20% stake in the consumer staples sector for shorting that overall my portfolio. Then I need to break down that piece of the pie. That's a 20% piece of the pie. I will then might have 6 slices of pie. In other words, 6 individual stocks. So then I have to break that down, 20% divided by 6, whatever number that is. And that's how much will go into each trade, give or take. I might overweight one over another if it's chart's a little better for whatever reason. Maybe the beta adjustment's a little different on that position. So I wanted to get that out there. So if you do see today, let's say I put out 2 stocks in the consumer staples sector, you might want to leave room if you're going to go the individual stock route versus the ETF route. Leave a little room for additional trades. All right, let's go ahead and dig into the charts. There's the bearish case for XLP. There's targets. I may or may not list XLP as an active trade. I'm still debating that. But if I do, you can see that the move down, and again, this is a weekly chart. That's about to the first weekly target would be almost an 11%. That's 10.75% drop. The second target, 18% drop, 18.2. And then final at this point in time, again, the charts are dynamic and so is my analysis. So as the charts develop or change going forward, my analysis may change, my targets might change, but ultimately that's what I'd be looking for, at least before all is said and done. The correction or bear market, if you want to call it, in XLP, probably about a 27% drop. And there'll be plenty of trading ops along the way to reverse these targets, cover, what depends on your trading style. But it's all there in the charts, in my opinion. And looking at the daily chart, we go back 2 days, you can just see this is a long-term trend line, the same one that we had on the weekly chart that comes in. And this is more of a zoom in, if you will. So there's that breakdown, back test. And then we have these minor uptrend lines, which we continue to break, sell off, uptrend, break, sell off, uptrend, break. And really, XLP at this point, I think a case can be made that it's most likely topped. And again, we can go in a lot of these trades with minimal downside loss if stopped out if the market or the sector moves higher, but a lot of potential on the downside. Okay, enough on that. We'll go through the individual charts and then we'll wrap this up. First one that stands out to me is Walmart. I may or may not add this as an official trade idea. And for those of you, if you're new to the site and all you've heard lately is a lot of bearish analysis on the broad market, keep in mind that I'm an equal opportunity trader. Walmart is a good example. This is my first one just because it's first on the list here. I had the list sorted by market cap, so Walmart's one of the largest in the XLP. But Walmart was a long trade idea. I added that back on, what was it? It was just off the lows, and it looks like November 3rd. So right here, right here. Caught Walmart within basis points of, of the multi-year lows, right there. And that was after a, 30-something percent, almost a 40% drop off the highs, a vicious bear market. And this is what I do. I catch tops and bottoms. It's my trading style. The case was made. At the time, I listed 3 targets. I called that one in early because we hit this first target, and it was a rather quick, some quick profits. So I closed the trade officially, but at the time of listing that, I gave 3 targets, and you can reference that. Just go to the completed trades. It's under the growth and income trades. Click on the Walmart symbol tag, and you'll see the 2 posts. And this was the 3rd and final target that I had at the time initially. And this is technical analysis, folks. This stuff, you can predict price movements within percentage points, if not basis points. So all the way back when the stock was still in free fall in a bear market, called a bottom. We caught that bottom. Hit the first target, and I might have even made mention that some traders could leave that on, longer term traders. A lot of times I'll just book quick profits if they're there, but it is, you can see we finally hit my 3rd and final target, which was right here at this line at what was that, 71.89. There we are at 71.96, so give or take. And as we went up, we'd form this rising wedge pattern. Now that rising wedge broke down at this point. If you look at it here, it was a nice bearish rising wedge, broke down, played out. These are just levels. I might have added some of these lines afterwards. Snap back up, but it looked like it went right back in this wedge, and right now we're getting close to the apex and we're starting to break down. But more importantly is this. This would have been my final target, was on the original trade, and we've now filled that gap there and hit that target. So a healthy move in Walmart, bearish rising wedge. We had one breakdown already, but we snapped back very quickly within the wedge, and I think it's going to break down again. We had a divergent high at that point. The fact that we already had this let out some of the air, if you will, in the stock, and that is why I'm a little hesitant, and I might not add this one. Although I have to say, I think the RR, risk to reward, is very attractive, because if you short it here, it's 71.96. We closed right at that line. I mean, right there. We didn't close at the bottom. That was the bottom of the trading on Friday, but it snapped back up. You can short Walmart with a stop above Friday's highs for minimal downside, and I think at the very least we come back to this level here, 66.55 or so. I'll move on, but I just wanted to point that out, and let's take a look at the weekly chart before we leave here. Yeah, there's a weekly chart. I also put up a weekly chart at the time, and you can see this one looks like it's come full circle. There was a big divergent high that set off that correction. That's when these are the notes from the original trade. I always confirm my charts, swing trades. Confirm the daily charts with what the long-term charts, the weekly charts tell me. So this was one of the reasons also for catching that bottom. It's not just random, luck, or let's say, the stock's down 70%, let's go long here because it's down 70%. No, down to support with bullish divergences in place, oversold readings. And right now, like I said, I'm debating this one, but probably won't add that as an official trade idea, but wanted to cover it for those. And it also speaks to where the sector is. If we're going through these charts, and I'm going through again in order of market cap, descending order with the largest companies. If Walmart and Procter and Gamble and all these big names come down, the sector will almost certainly go down with it. Here's PG, very significant support level here. You can see numerous reactions there. It's been trying to get through that level. Divergent high. This right here, we just peaked out, made a marginal new high right there. I don't have it drawn out, but I think you guys can see that. There's the divergence, and it's shown down here with the MACD, which is now looks like it's curling down. The RSI, we have that divergence there. Again, I will follow up with the official trade ideas. I might have to cut this video a little short. There were so many that I wanted to cover that stood out to me, and maybe I'll just go quickly over these. You can look at the charts, see the same things. Divergence, there's Tira Group, let's see, CVS I had on there. CVS looks like it's about to give up the ghost on a break below this level, 91.50-ish. Horizontal support. Yeah, it did that once, but it snapped right back up in there. You know, the common theme that I'm seeing in the stock market and a lot of sectors, including the components XLP, the consumer staples, is what I call a WTF rally. You know, a lot of things broke down. We had some solid sell signals, and we had this ramp that I discussed it within the broad markets. I did a video on IWM focused solely on that we had this unnatural ramp, which to me was just a final gasp, if you will, a big short squeeze, and so far the selling has been pretty impulsive. So these breakdowns, my point is we had a lot of false breakdowns earlier in the year, one more ramp up, and I think that was it. So the next time this level goes, I think it goes for good. There's CVS, that's a daily period chart, and when you look out here on the weekly chart, this must be some old notes, but you can see a divergent high. There's your bull market uptrend line, breakdown. After the breakdown, one last thrust up, which is it's common to see that, and then boom. So if we go down, I think that one's easily headed to that 8180 area in time, CVS. And again, I'm giving you these. Some of these will be unofficial trade ideas. Anything you see on here, if you like it, go ahead and short it. But the official trade ideas will have exact suggested stops, price targets, and stops and price targets, I should say. All right, RAI, Reynolds American, pretty clear uptrend line, breakdown, got above it, back testing, and not my favorite. Yeah, there's a weekly, I should have mentioned, there's a weekly chart. You can see that trend line there. That's probably a better trend line to use on RAI, but again, not one of my favorites. All right, why don't I just jump ahead to my favorites because there's so many on here. Let me just go to the ones I have an asterisk by. That'll probably be official trade ideas. KMB, Kimberly-Clark. Look at that beautiful bearish rise and wedge. Look how well defined that is. Breakdown, impulsive. That confirms the nature. It validates that trend line. It validates the wedge. That impulsive move down, then another gap. Hit that support level. And now we're wedging up again. Once again, a rising wedge. You can see the MACD. Looks like it is turning over. It hasn't made a bearish cross yet. We became almost overbought again on there, right? Fell just shy of the 80 level, and this one looks to be headed back down to at least that level again. And let's see if there's anything that stands out on the weekly chart. Yeah, there's a long-term uptrend line, which would be a great one of the price targets. I think that level will eventually go, but yeah, looking at this, I think we'll go down once that level goes. We'll probably have a reaction there and then move on down to the 103.40 level. All right, next up would be GIS. And again, you guys know all these names. General Mills, here's your cereals and everything else. These are all the, like I said, consumer staples, products that you buy thick or thin. And, you know, the bottom line is they're just too expensive. You know, the P ratio is almost 30 on this one. GIS, there's a nice rising wedge, very steep divergent high. Looks like the MACD is rolling over. That divergence isn't confirmed yet. In my book, I like to see a bearish crossover, but good enough. And I don't think, you know, looking at where this stock is within you know, the proximity of the apex of the wedge, apex or where the two lines meet, this is about where this thing's going to break down, if it is going to break down, and I do believe it will. So there's GIS. That one looks good. I haven't really done anything with the weekly chart. Oh, you know what you can see here? When I go to the weekly charts, I've added PE ratio down here. Here's your historic PE ratio. This is a 10-year chart. So forget about the trend lines. I really don't have this one cleaned up yet. I can do that later. You can see the divergence there. There's your long-standing divergence. But more importantly, look at the P ratio. It's 27, over 27. Back here, the P ratio was down around 15. That's where a consumer staple stock, you can see these are long-term averages. That's where stock should be. At the end of a bull market, or at the end of a bull market, they peak out. Could probably expand this. You can see P ratios get high and then they get cheaper. And this is where at the end of a bear market, stocks are cheap. But this is, extreme froth, and that's just a common theme in these stocks. So again, market can fall. And some of you, especially if you have a background in finance or economics, you're told, well, this is what you want to own during a recession. I already showed you the chart. We started out with XLP and what happened during the previous two bear markets, how it held out, up to a year after, because it did see that flight to safety, but then it just crumbled under its own weight because too much money ran into these stocks and ran them up to excessive valuation levels. So there's GIS. That's one I think has a lot of meat on the bone. You can see that would be my target right there. Ultimately, I may add additional targets, but we'll call it 60, roughly the $60 level. KR. Kroger Company, oh yeah, nice level. Look at how well defined this support level is here. We had that, looks like a little mini crash back in when a lot of stocks had a mini crash. So I just almost dismissed that candlestick. That was a flash crash in KR. So again, the simple break of $34 is the trigger for that one. And when you look at it from this perspective, here's a long-term uptrend line on a weekly chart, and you can see that support shelf right there. There it is, around 34. And if that one goes, I think that'd be our first target down here where that flash crash type spike went down to, and that's all the way down to 27.54. So, I talked about the gains being a little muted. These are actually pretty, especially if you're willing to ride them out, tuck these things away for a couple months. You're talking a 19% gain to the first target, and there's a lot of froth to come out of these stocks. So if you're really, willing to sit tight, maybe you game it, tighten up, take some profits there, reshort if it breaks that level again, or just hold on. And ultimately, I think in the next couple of years, within the next year or two, this stock will see that $22 level. So that's KR, Kroger. We're on a weekly chart. I'll just stay on a weekly chart as I skip to the next one. Constellation Brands. This is I talked about in last night's video with the consumer staple stocks. There's certain subsectors of the consumer staples, such as alcohol in this case, that tends to do well during a recession normally because people are depressed, they drink more. This is a long-term chart that tells me this stock is just, you can see down here. So at the high end of its valuation range, there was a trend line there that broke down, but this is the pattern to watch. This is the more important trend line right now. We have this uptrend line here. You also have that 40-week moving average there. If and when that stock breaks that level, which I fully expect, you can see the divergence already shown here on this weekly chart. That one's going down to first stop would be the 113, a little above the 113 area, and then after that probably around 90 or so. Here's a daily chart to kind of hone down entries. And again, the ones like this will probably be an official trade idea. I'll put these charts up on the site with specific entries and price targets and stops. But you can see there, break of this trend line will bring us down here, that 131. And these are some, I don't want to call them micro targets. These would be the official targets on the daily chart. That weekly just helps to affirm or confirm the bearish nature of the stock. TAP, here's Molson Coors, another alcohol beer company, and you can see just a very clean rising wedge. This one already broke, so that one's good to go right now. Let's see what happens today. Maybe it pops up, gives us a back test for an objective entry, but these are your levels along the way that this stock, and ultimately before all said and done, I think that one comes back down to that almost 79 level. Pretty good support there. Actually, a very nice support level. And let's see. Yeah, you can see it here as well. I think that would be, at least for now. Again, I'll follow up with some official targets, but that would probably be a the final target on that trade if I make that one official. And finally, again, there were a lot more. This video went longer than I wanted to, so I can't go over all of them. But CPB, here's Campbell's Soup. Again, I told you all household names. I think everyone listening to this video knows every one of these companies. And if you don't, I can assure you've probably used their products. Let's see, there's a nice gap right there. There's some, yeah, so this one, I like this one because it just started to on Friday. And again, Friday was a big move in the markets. Let's see some follow through to Friday before we do too much. I also mentioned the markets are at, broad markets are at support, or at least they closed at support Friday. We're indicated to gap down. The market hasn't opened yet, but nothing huge, not anything huge. So I'm going to sit back before jumping the gun and adding much more short exposure. But I'll get these setups out for you, and I'll wrap up here with Campbell's Soup. There's just such a clean pattern. You know, it's steep divergence right here, negative divergence on that high, came down sharply, moved up. You could really draw, put this as an ascending price channel, and looks like we just cracked on Friday. But again, let's see a little more follow-up, and I'll put down what I think are the most objective entries on these. That's what it's all about, being patient, waiting for the right entry. And again, here's a sector with a lot of downside potential. I was at first thinking that a lot of these trades, my targets would be single digits, and I will give you some near-term targets that are in the single digits, because there are some traders that don't do well sitting and waiting for a trade. They don't do well riding out those counter trend bounces. Every time a position goes against you, you get nervous. I hear it, and it's human nature, and that's fine. And it also, I think it comes with the longer you trade, the more patient you get with these trades. But with that being said, for those of you who want to get a few wins under your belt, focus on those for early targets. That's why all my trades have multiple targets. Not all of them, but most of them have multiple targets. And those T1s, those first target levels, those are for the traders that want a high probability trade. If you focus that first target, you book your profits there, or lower stops down at that point, trail your stops down, you're going to get more wins under your belt. Yeah, the percentage gains are smaller, but the probability, it only makes sense. The first target is going to have a higher chance of being hit than the additional targets if you think about it that way. But again, the success rate on the trade ideas on the site is extremely high, especially if you're only focusing on those earlier targets. And again, with the potential for a big move down in the markets, another strategy is, as we hit those targets, lower your stops to protect profits. And then you can trail things down or take partial profits at those early targets and let the rest ride. That's another strategy. So, all right, this has been Randy Finney with the right side of the chart. I hope you enjoyed the video. And as I said, I'll get some of these out. Just be on the lookout for some of these trade ideas to trickle out over the next week or so. And if you're going to take the individual names, just make sure you leave room in your portfolio for maybe, I would say, if you're going to short the sector with individual names, you probably want to do at least 4 or 5 names minimum. Otherwise, you're better off going with the ETF for the diversity. All right.